Today, the widely known and loved Jeremy Siegel is on CNBC, and he's saying no way bonds are as good as stocks for the long run and wealth creation. So he's going to give his opinions on that, as well as what to expect from Jackson Hole. Guys, this week is going to be crazy. We've got NVIDIA earnings on Wednesday, Jackson Hole on Thursday and Friday, and it is just going to shake up the market absolutely crazy. So I hope you got some cash on the sidelines, and I hope you're ready. As well, I got my Lahaina Maui shirt on. My prayers go out to anybody affected and anybody that knows anybody. Alrighty, let's jump into what Jeremy Siegel has to say.
Jeremy Siegel, professor at the University of Pennsylvania's Wharton School. Good morning, Professor.
Good morning, Steve.
Okay, so let's start off with where the economy is now. And Jeremy, you have an idea here about what's going on with productivity that's, I don't know, I don't think people are thinking enough about this. We've had...
If you don't know who Jeremy Siegel is, he's a professor at the Wharton School.
A couple lousy quarters, and then we had a couple really good quarters. Do you think we're really having a productivity surge in this economy?
Well, yeah, I mean, the last quarter was, outside of the few months around the pandemic, the best quarter for productivity in over 6 years. And if this quarter, I mean, we've been, I know the St. Louis Fed is way up there. Others are not that high. But, given modest growth in hours and in payroll, it looks like another third quarter boom in productivity. This is really saving Jay Powell. I mean, this is the best news. I mean, that's how you can have strong GDP growth without pressure on the labor market and really without pressure on inflation. I mean, that's the golden magic over here. So I think that that's really playing into what we see in the economy. And by the way, why yields are going up also, real GDP growth and real yields. I'd like to comment. You guys had a great discussion right at 6 o'clock when you opened about real returns and the tips going to 2%. Is that a way that you should now invest in for wealth? Let me mention 2% a year. It's good. It's the biggest in decades. However, 2% after inflation a year takes 36 years to double your money. At a 20 PE, which you also mentioned, which is right, that's a 5% earnings yield in stocks, the general S&P 500. That takes 14 years to double your money.
Night and day difference. I mean, not even close.
So,
okay, all right.
By the time you double your money in bonds, you've multiplied your money by 5 times in stocks. So people who tell me, oh my goodness, bonds are as good as stocks, no way for long run wealth creation.
Let's unpack that, Professor, because I think that's important, and it's kind of against my thinking on this, right? Which is
you'd like to like bonds, but you can't.
I really want to like
bonds.
bonds.
You can't make that case.
I'm going to try.
Nobody has ever built wealth.
Professor, you're telling me I can see this 5 juicy percent 2-year note, and I put my money in there. At the end of that period, I'm going to get 5%. And that's going to be 3 percentage points or 2 percentage points higher than the inflation rate. And I'm going to be really happy. You're telling me I'm going to be unhappy because I was better off putting my money in stocks. I should ignore those big, fantastic yields on the 2-year.
First of all, in 2 years, anything can happen. we know that. I mean, the stock market could go down 10 or 20%. I'm talking about building longer-term wealth. And I'm saying if particularly if you're young, you're building a retirement account, you're thinking about, your retirement, that's what really counts. And, even, 2% is certainly attractive compared to earlier. By the way, when tips came out in 1997, they were 3.5 and they went above 4. So, I mean, even though 2 is certainly better than it was 10 years ago, 5 years ago, et cetera, and so on, it isn't all that great compared to history and well below stocks. The average over 200 years is 6.5, and I'm giving a conservative 5% after inflation rate of return in stocks. You are absolutely right. In 2 years, you might be very happy with bonds. You might not be happy with bonds. But over 10 years and 30 years, you're not going to be happy with bonds.
If rates go down, you have nowhere to go.
This is absolute gold. They have been pushing bonds as safety and so much free money, and you can get the 5% without the risk here. Yeah, but you're also missing the best times to put your money on the dips and the best companies. And if you're focused on long-term wealth creation and you've got a time horizon, wasting your time and money in bonds, that's what Jeremy Siegel has to say. He just proved it to you. You want 28 years to double your money, or do you want 14 years? I believe those were the numbers.
You're stuck with your stupid 5%. And then, you know, if rates go up, I guess you can reinvest a little and then you can get 6%. But, you know, if you don't want to buy NVIDIA and make, you know, whatever, or the Magnificent Seven or something really sexy, you can buy really good companies that have a yield of like 2 or 3%, and they raise their dividend every year for 15%. So suddenly the dividend is up to your 5% in a couple of years, and you got the capital. It's just unless you need a stable part of your portfolio that you know you're going to get a return of. But and if it's not corporate, if it's not Treasuries, then you even got to worry about getting your money back anyway if you go out the
and then you got the reinvestment from Professor. Can you handicap this weekend?
So you believe that? You don't. That was a devil's.
I know.
You were just trying.
I am putting a portion into the 2 year. I am buying.
You are?
Well, with the cash that I have,
you know, if you put 10 grand in, and I told Kelly this last week, you get four. This is on a longer term, but four. It went from 4 to 4 1/4. That means, you know what that means on 10 grand? If you take your wife out, you can get an appetizer after a year. Right?
Everybody likes an appetizer.
Yeah, because instead of $400 that you get on 10 grand, you get $425. It's just like...
It's laughable, guys. Make sure and get 2 appetizers, actually.
Come on. This is a stock market channel.
That doesn't mean people should only invest in stocks.
No, but it kind of does.
Professor, can you just handicap this week and what you think Powell should say, what he will say? Where's policy going, and what does that mean for the stock market?
You know, very, very honestly, Steve, and of course you follow the Fed so closely. You know, since the 3.5 weeks, I guess it is, since the last press conference.
All right, real quick, just before he gets into Jackson Hole, guys. I've had my share of both sides. I haven't quite had bonds, but I went after the yield and the safety. I had a dividend portfolio of over $27,000 I was building up. I was just putting money in consistently week after week after week. And if yield is what you want, start a dividend portfolio with dividend aristocrats and dividend kings. You'll get appreciation from the stock, you'll get the dividend, and you'll get the dividend rate increases, guys. If yield is what you're going after, these bonds are not going to last, in my opinion. He's already showed you the math that it's going to take almost double the time to double your money. Might as well get something that's going to keep increasing their rates, aka a dividend paying stock. For a young 20, 25, 30-year-old person, I don't see any place in the bond market, honestly.
I don't think a lot has happened that changes the outlook. I think he's going to say, you know, we're not, you know, quite done. We're close to the job. I think he's going to stay very data dependent. Don't forget, we still have a full month with a full month, a load of data announcements coming out before the September 20th meeting. So he's going to stress that data dependency. You know, I think there will be a kind of a slightly hawkish tilt because, you know, we're not down to that target. But, you know, honestly, I don't, you know, if you want to know the truth, the higher real yields and the higher interest rates are working in his direction towards tightening policy without
Professor,
raising,
I want to cut you off on that real quick.
rate.
But here's the thing. If he follows what you talked about at the very beginning of this conversation, that productivity is higher, that we can have stronger growth, lower inflation, and a low unemployment rate, would you tell him that he should not be hiking anymore and that maybe he should think about cutting?
I mean, I would be on the alert, but I would say, yeah, you don't need to hike anymore. You know, you got tightening on that long end since the last meeting. And when we take a look at all the other you know, the break even between the tips and the 10-year, which is one of their favorite indicators of what 10-year inflation is going to be, it's 2.3%. Okay, that's not 2.0, but my goodness, that's you know, take a look at what the market is looking at longer term and seeing those trends. I don't think that's threatening. And you want to start, listen, the term structure is uninverting. Do you want to invert it more? Yes, you will if you raise another 25 basis points on the 10-year.
Professor, it's always a pleasure to talk to you.
On the Fed funds, yeah.
Professor, always a pleasure to talk to you. Thanks for joining us this morning.
All right, there's Jeremy Siegel for you. He is such a knowledgeable man. He even knows how the Fed thinks, what metrics they use, what indicators they go after, and he bases his opinion on that and so much more research. He's a professor of finance. This guy has made his name over years and years and years of being directly in the finance market, and he puts his name out there and he makes a lot of great calls. I hope, as always, you guys enjoyed this video, and if you did, hit the like button, and I will catch you in the next one.